Welcome to the CEO Bros Podcast, After Hours, with Brian Baldoff, co-founded, grew, and sold VHT Studios. Brad Baldoff, CEO and co-founder of By Your Side Autism Therapy Services. Matt Croak, the consummate entertainer, jack of all trades, and serves as our host.
More importantly, to our viewing audience in the grand country, the 7th largest country in the world, but most populated, India. We appreciate your show.
Thank you, India.
Thank you.
I always thought it was China.
Here's to India.
Please hit that subscribe button. Let us know you're there.
A very important ally of the United States. We appreciate the country.
That was good. That was fun.
Yeah.
So another quick question I have. Can I just do questions today? Is that okay?
Yeah.
I was watching the podcast number 18. Which was Go Back and Visit. That was one on
CEO
sales.
Bros?
Yes, CEO Bros. Okay. Number 8 of Suits, season 3, episode 4, section 3.
I'm not going to know anything. Yeah.
No, episode 18.
And episode 18 was on sales. That was the one that I was not here for. Right. So I revisited it, and it was a great conversation. So go watch it. A quick question on it. You didn't really address this. What about how do you avoid the pitfall of being too salesy? Like what?
That is, I don't know if discipline or skill or
you know
practice,
what I'm saying,
but
right?
it's very, very important. Yeah, I think people that are new are typically too salesy, or people that are haven't practiced their studied sales. Because we talked about it, it's an art and a science, and sales is not about being pushy. That's the common misperception about sales. Sales is helping someone come to a conclusion, using their, asking questions, using their thoughts and their answers to help them make decisions. That's the art of sales. So if somebody's pushy, they need to go to training. They need to be educated on what sales really is, and the techniques and the methods, and because it is not pushing something down your throat.
And I know you were very successful at it. What did you do to be authentic? How did you connect without being too over the top salesy? Type of just.
Well, I think it goes back to what Brian's saying about you have to be thoughtful in your approach when selling, and it's solution selling. And then the only way to solution sell is to do the upfront, inquiring and asking a lot of questions and understanding what the needs of the business. Because if you come at somebody with your product as the answer without knowing what their needs are, you are a pushy sales guy, and no one wants that. No one likes that. So, but if you come in and you approach and you're thoughtful in your approach, you get the adequate training, and you are literally trying to figure out the needs of the business and then fulfilling the needs with a solution selling approach, you will more than likely be successful. But the reason why a lot of people don't do it is that requires discipline and patience. And if you don't have that, you're going to come across as a pushy sales guy, and no one wants that. So when you say is how do you avoid it, you definitely have to become more disciplined in your approach, and you have to become much more thoughtful with your questions. That's what I would say.
Answer your question?
Yeah, it was good. And I recommend going back, visiting episode 18, all the episodes, but that was a really interesting conversation. I'm sorry.
We can spend a lot more time on sales. We probably will in the future too. Have some people in that are experts in sales management, sales training. So I've got to follow up too.
Speaking of thoughtful though, our good friends at Tito's Handmade Vodka. We love them because this drink right here is a Tito's Press. For those of you that don't know, it's
Brad's
a little
fourth of the night.
It's a little.
He wanted to make sure he really wanted to.
It's a little vodka, soda, and ginger ale mix. Press being short for Presbyterian, and an old term from the 1940s. A lot of people don't know that. That's the vodka press.
That is not. Is that what press comes from? Presbyterian?
Yes, and that's Tito's.
I'm learning
Press.
a lot tonight.
I am learning a lot today.
So. Please.
So I had one more. I don't remember what episode it was, but I think my kids watch most of the episodes because they ask good questions. But they kind of proved it this weekend. They got me something, so I brought another.
Oh, you have another show and tell
item.
Okay.
I don't know if this was about decision making or communication, but Actually, a lot of people brought up this topic, but they went overboard. They got me a sign for our pool.
Way.
Oh my God, persons having currently active diarrhea or who have had active diarrhea within the previous 14 days shall not be allowed to enter the pool.
Now, it's going to have to be quick, but let's quickly tell it because people may not go back right away and find that episode. You both saw this sign at a pool.
And on the gate to get in the pool is a massive sign.
A steel, like a metal sign that would cost 60, 70 bucks.
Wait, what city? Where were the Bears playing?
San Diego.
It's probably San Diego.
We were out by the pool.
And it says, if you have or have had active diarrhea in the last 5 days, do not enter the pool. Big letters. And we're like, how serious was this problem?
Yeah, we were sitting there. It's like, you can't get that at a gift bag. I mean, a goodie bag up front. You get some candy, a couple bottles of water, and a note that says, don't do this in our pool. They actually had to invest in like $80 or $90 signs at like 1,000 hotels across the country. I'm going, how bad of a problem was it?
I think it was even bigger than this, and there was multiple copies of it on every gate, every fence.
And I don't think it's the idea of, I don't think anybody wants somebody with active diarrhea in the pool.
Right. We're not arguing that. We're not saying this is a bad policy.
We're fully supportive of those with active diarrhea staying out of pools. But the question and the discussion became around is, to what extent does the problem have to occur that you have to invest in $40, $50, $60, $70 signs to be put up on fences across a hotel chain with 900, 1,000 locations? And that was what we debated. We're like, how bad of a problem could it have been?
Not paper and pen, no, signs.
Yes. Like how, so it's decision making, it's communication, it's disaster.
Somebody had to call a meeting. Somebody had to call a meeting and say, I need this for the budget.
Right. And we have not had this problem at our pool, but now that I have this sign, I feel even more comfortable. We never will.
Right. I feel that I'm going to get calls from our sponsors who have already expressed interest in being showcased for longer than 10 or 15 second spots like we do with our good friends here at Tito's. You just held that sign up about active diarrhea for more than a minute and 30 seconds.
Pepto-Bismol, you want a sponsor?
So how much did that sign cost you?
Yeah,
well, it was a gift, so I don't know how much they invested.
Right.
And so can I ask
you can't just go to a sign website and buy this. No. This is custom made. You have to request that verbiage. This isn't like this is like one of the top 10 signs.
And did it go through an editing process when they're like, all right, we approved the sign. What's the verbiage going to be? How did that all work out?
And I want to know the thought process of the business owner that says, I want to be the business that sells that sign.
Because now they're going, this is becoming popular. Maybe we should feature this sign.
But then the window.
Big on CEO Bros. Perhaps we should start a business that sells these
really
signs.
Spiked the day that the CEO Bros featured us.
They get put in that back basket, that back sales basket of the retail location, right along with Brian's Afghan business, where nothing's selling quickly.
So this is a story that's never going to die. But
no, I appreciate the sign. That was very nice.
Because we didn't have the sign during the original episode. We didn't even have a picture.
We did not.
It
was just a story.
But
it was just a story.
That's how ridiculous it actually is.
There's people out there that said, "Hey, that was a really funny anecdotal story over 20 seconds. You guys have just turned that into a 20-minute segment,
the whole episode."
But the way you guys described it, I could totally see you both and your other friends all saying, carrying that over for like 3 days and just keep coming up with, and then somebody had to put it up there, and then what was the meeting approved? Like, what was the budget?
Well, it's gotten to the point where he now owns a sign. His kids now own a sign.
The legend lives.
And Brian's investing in the sign business. So we're
just asking questions. This is an interesting episode. Any other questions anyone have right now?
No, but I know you were with the one point we were talking about was growth.
Well, that's another one I had. So if no one has one, I'd like to. I know growth was mentioned. I don't think you've talked too much about growth, or if you have, like for growth, would you rather acquire growth, or do you consider growth organic, what you do yourself? I don't think it was really defined when I heard growth of what the thought of organic versus acquiring.
It's a great topic, actually. Yeah.
It is a great topic. And what's ironic about it is that Brian and I, coming from different backgrounds, grew our respective companies in two different completely avenues. So let's let's break down terminology for people. When you hear the terms organic growth versus inorganic growth, when you hear those terms, organic growth is basically de novo, or the growth of a business from within, right? So you're opening new locations from scratch. You're adding customers on from scratch from what you already have. Inorganic growth is via acquisition. So you're essentially looking to expand the scope of your business, but you're doing it via acquisition. And ironically, Brian and I did it two different ways.
Right. And by acquisition, acquiring competitors or other people in your field. I do think, so there's reasons for both. And every business has to, I think, start with some organic growth, because you got to prove out the model. Otherwise, you don't even know what kind of acquisitions to do, what makes sense, what's going to add on. But, some of the criteria are, at least for us, it was speed. We had outside investors, venture capital, everything is about growth at not all costs, but as quickly as possible. And
let me stop you there. Or let me ask you, I guess, because we didn't buy, or we didn't acquire. We grew de novo. We opened new locations. Would you say that one point of inorganic or contemplating acquisition is you have to have funds? Because if you can't pay for an acquisition, like growth, new organic growth to me takes longer.
Yes.
But is less capital intensive. You don't need as much money up front, potentially, as you do need for acquisition. And maybe I'm come from a different school of thought, and maybe I've got it wrong.
Well, no, this is a good discussion, because there's two things in that. One is it's a different type of capital. Organic growth is all operating expense. And so, it kind of depends. So you need money.
You need money, but.
Right. But it depends on what's important to your investors or your ultimate acquirers of going public. So organic growth is all sales, all marketing, all your own customer service people. So it's operating expense. Acquisition is more of a balance sheet type of transaction. So it doesn't impact your necessarily P&L. Your profitability, your P&L. Hey, is this business profitable or isn't it? It's a more of a financial transaction that can have an impact on your P&L. So we did two different, there's a lot of different types of acquisitions, but we bought some companies that were immediately accretive to our P&L. So we would spend $1 million in capital on our balance sheet, and our operating income would go up because they were making money. So we looked like we were growing, but it was overnight. All of a sudden, the next day, we're doing $1 million more in revenue, $500,000 more in profit.
So if you're a break-even company, your point is you purchase a company that's got $500,000 of annual profit. Well, guess what? If you are a break-even company, you are now a $500,000 profitable business.
Yeah.
Overnight.
Yeah,
because you've put them into your balance sheet, and your over P&L is reflecting that. So that benefit of the inorganic acquisition approach overnight is very attractive.
Yeah, and you see that with a lot of companies. Like Cisco Systems was probably one of the biggest. They've been around for 20, 30 years, but they acquired tons of companies. Sun Microsystems acquires companies. NVIDIA acquires companies. Part two of your question, which was, well, you have to have capital to do that. Not necessarily. There's ways to structure acquisitions where you don't need cash up front. And we can talk about some of those. There's different ways to structure things. There's earnouts, for the previous owners. There's kind of partnership agreements where if they've got some other business, we agree to do work with their business if they give us this line of business. So it doesn't always require capital.
How about the acquisitions that you did? It's interesting from my perspective, because Matt, being a member at By Your Side, we've grown organically. We've opened new centers, started with 1, grew to 2, grew to 3. Now we're up to 11. We've contemplated acquisitions along the way, but in almost every case, the 2 or 3 previous acquisitions we contemplated, you're paying a multiple on the cash flow of the business. So for those that are out there, if you're interested in purchasing a business, let's say the business has $500,000 of annualized profit and they expect to sell at a 6 times multiple, they are expected to be purchased for $3 million. And that's why I was saying it is pretty capital intensive if you don't have $3 million. Now you're talking about, well, there's different ways to structure getting the $3 million to buy it.
Sure.
Could be equity in the business, could be earn out over time. But that's part of the reason why we've always kind of shied away from it, is because the expectation in this space has always been that there is some huge multiple that everybody thinks they should be paid out. Everybody thinks that their company's multiple is higher than what it actually is. And so we've just chosen to say, well, we're not looking to exit. Over the last several years, we haven't been, interested in exiting. So our whole point has been, well, why don't we just continue to grow? Because your operating expenses in the business, putting money into marketing, finding a space, paying a new lease, hiring employees, doing marketing, that's your cost. And so it takes you longer because you're spending and you're bringing in revenue over time, and it's an organic growth. But I can see the appeal of inorganic acquisition if you can right away aid your P&L bottom line profitability. If there's a way to structure the capital in a way where you don't have to come out of pocket.
Yeah. Oh yeah. There's a lot of considerations, and not all businesses are ideal for inorganic growth. There's different reasons for doing it. They're strategic. Like, for instance, if we're in a first mover type of business, and so think like Uber or Lyft, and they got to be the first one in, first mover in New York City to get the airports and the hotels and stuff like that is going to win. And there's already somebody there. Okay, it might take me 3 years to build up an operation in New York City and cost me $3 million, where I could just buy these guys for 6 and I'm there. I'm there tomorrow. I could block everybody else
First, biggest,
out.
best.
Yeah, I mean, Grubhub did this with food delivery. They merged and acquired with people. So strategic's a big one. Competition. Sometimes you just need to take out a competitor. We did that with one company. I won't get into the details, but they were a low cost provider, and they were killing us because they were giving stuff away, and they were always the discount. And well, your competitor's doing for this. We basically bought them and shut them down. Mm-hmm. And then we were able to increase our rates and make a better margin, better profit. So
I'm just curious, were they open to that? Do you think that's what they wanted in the long run, or did they fight you on it? Like, we don't really want to be bought. How easy was it to acquire them?
No, so they came to us because they actually were kind of in 2 businesses, and somebody wanted to buy the right side of the business, but didn't want the left side of the business. And we said, well, we'll take it off your hands. And, they gave us a great deal on it. And we were basically... Well,
sure they did. They gave everything else away for free.
Right, yeah. I
hope so, yeah.
And as we talked in the sales podcast episode, I think it was 18, we were talking about when you throw everything away, the customer will build a big gold statue of you.
Well, you put the number one question I get from, founders and CEOs that call me is, what's the multiple for my business? How much, could I get for it today? I'm like, well,
whatever whatever the market is willing to pay.
Yeah,
for it. It's not what you think it is. It's what the market is willing.
There's
to pay.
no standard number. It's really
there's perceptions.
There's guidelines.
There's perceptions. There's guidelines. There's precedent that's out there, but that's some of those precedents have occurred, like, say, years ago. And then people are like, well, that's what I want. It's like, well, the world's changed. I mean, the macro environment changes, interest rates dictate things, the bond markets, things that is there a lot of dry powder out there? You hear the term dry powder. Are there a lot of firms, private equity firms, sitting on a lot of money to actually acquire companies? Are they ready to buy, or are they ready to sit? And so there's a lot of outside factors that we've seen in our space. But I was going to ask you, Brian, did you plan on having the inorganic route all along, like, we're going to grow through acquisition? Or did you make a conscious decision at a certain point and say, we're not growing fast enough, so now we have to go the acquisition route? Or was it something out of the gate you said, no, it makes sense, we're just going to grow from?
So it wasn't there from the start. even though my, prior position with AT&T was doing M&A work, we were acquiring companies, so familiar with how it worked. But we built VHT for the first 10 years. Then in 2008, the market crashed. We tried to go a different direction for 4 or 5 years. We came out of it in 2013. And at that point, our investors were going, okay, we got to get going here. And
we got to see more bang for our buck.
Yeah. And we don't have, millions of dollars to try and hire new salespeople and open new markets and do more marketing and hire more customer service. Very labor intensive. When you talk about multiples, generally, labor intensive businesses have lower multiples than software and platform businesses that sell subscriptions and don't have a lot of operating costs. It's just memory, processors get great multiples, 15, 20, 25x EBITDA, whereas the service business is probably single digits, maybe 11, 12 at the high end if you're really growing. There's a general rule. I think we talked about it before, the rule of 40. The ideal business for an investor when they look at multiples is a combination of growth and EBITDA, earnings before taxes and depreciation, of 40. So if you're growing at 40% a year, you don't have to be profitable at all. You're potential unicorn. If you're growing at 20%, then you better have 20% growth and profitability year over year. If you're at 40% profit, you don't really need a lot of growth. That's a great business. That's kind of the, venture capital benchmark is that rule of 40. But that idea for us, it really became okay. In the 14 years we've been doing, when we were first to market, it was easy for us to establish ourselves in places. But over the years, there weren't high barriers to entry. Like people could just copy our website. They could provide the same services, same pricing. We didn't have a unique competitive advantage other than we were great at what we did.
You're a guy with a camera.
Right. Yeah. Pretty much.
I mean, not you, but other companies
that's
could say
how
that.
they could say it. Hey, we do 10 photos for $100. Agents aren't going to know the difference. So tons of copycats. Real estate's very local. So every market had 2 or 3 VHTs that built the relationships, had the photographers, had the ground game. We're bringing donuts and bagels to the offices on Monday mornings. So when we, would try to crack into a market like Dallas, it's like, we're going up against the guy, who's been here for 14 years. He knows every agent, every brokerage. He's got 50 photographers on the ground. It's going to cost us a fortune to dislodge this guy. It's going to take us 3 to 4 years. This is different than when we first started. Because when we first started, we could go into Cleveland, and we're the only ones providing professional photography. So that's when we realized, especially the other thing about our business in particular is real estate agents develop a relationship with their photographer, and it's hard to break. It's like their partnership. It's a service provider. Jim's my photographer. So that was very hard to break. So then we said, well, what if we can just acquire that business? And Jim comes with it, and he continues to shoot for the agent. They continue to get the same products and everything. And the real beauty to us, and this is what we put in our pitch decks when we were selling our company, is that the model was beautiful because we could find a provider in Dallas that was doing, $2 million a year in revenue. They were doing, 50% gross margin. So, 50% of the money went to the photographers. They kept the other 50%. Maybe they were making a 10% profit on the bottom line. And, we could buy the business for $2 million. Multiple was, well,
that sounds pretty expensive because you're paying, if exactly what you just said, if you find a business with $2 million in revenue with a net profit of 10%, so you're making $100,000. And you're buying them for $2 million, you're paying 20 times multiple.
Well, so we could buy it for $2 million because we had the biggest customer service operation in the country, billing, legal, accounting. So we didn't need any of their expenses.
You did back off.
So
you no corporate expense.
40% of their expenses would disappear the day we bought it, and the profitability would skyrocket
because the customers and the revenue are still present.
So we knew we could pay a lot for the business. Then it gets into the negotiation, which is, okay, well, we're, it was funny because we saw this with Coldwell Banker in the early days had this approach of, we're the biggest in the business. We decided we want to come into St. Louis. You're the, big provider in St. Louis. You can either take this check or here's how we market ourselves we're going to bring 10 salespeople. We're going to spend $1 million a year in advertising. We're going to steal all your photographers. We already, 3 of your clients are national accounts of ours, but we'd prefer to work with you. And then it really just came down to, does the owner want to stay or does the owner want to leave? And people are doing it as a lifestyle business. They weren't going to sell, but a lot of people after the crash of 2008 to 2013, they couldn't wait to get out. It's like, I don't want to deal with the cash flow. I don't want to deal with the risk and the stress and all that other stuff.
So, acquisition, accelerated growth, alternative ways to structure deals that don't necessarily rely on you being capital rich. That you don't have to have all the capital. That's clearly a route you
usually
could go.
We would take a loan to acquire a company.
Okay.
So we would take like a 7-year loan. Interest rates were low.
Mm-hmm.
So we would do the math and say, okay, the monthly payment on this is, $5,000 a month. The company's throwing off $10,000 in profit.
So this is
a no-brainer.
So the biggest, all right, so you're throwing a lot of like green light. This is why we do this, right?
Sure.
Now the downside, and the reason I'm asking is because I'm finding an interest in whether or not we want to go that route ourselves right now in the autism therapy
There's a
business.
lot of interest in rolling up.
And now it becomes your
space.
biggest challenge, I would imagine, in that world, which I am not have the experience that you're doing, is the integration of the current.
Always
You got to roll them into your house. And somebody's got stinky feet.
We did a whole.
Someone's got like lice in their hair, and you're not taking them out. I mean,
Skeletons in the closet?
Skeletons in the closet. Is that at the end of the day? Would that be your? Because you're just giving all these bing, bing, bing. This is right. Let's do this. That's got to be the biggest.
We did a whole episode on culture.
Yeah, well, culture is a big part of it.
Is it
Technology is a big part of it.
in the overall?
Processes, integration. Yeah, so it's the biggest consideration of can this work or not. And then it's the biggest chore after the deal's done. Because everybody always celebrates, hey, we acquired them. It's like, great. Now we got, a 2-year project of getting their customers switched over to our billing system, getting their website integrated to our website. And if somebody, fortunately for us, a lot of people had just copied us. So they had the same products. Similar pricing, but less expensive. Yeah.
I'm in that flyer.
So not a lot changed.
Brian Bald, that's my name.
Right. Wait a minute. Not a lot changed for the customer. Because if you buy somebody and then you force your stuff on the customer, you're going to lose half the customers.
Yeah.
But we could keep the customers because they were kind of getting the same thing. I mean, we did have different model. We found out that our model was different than most of our competitors. And I think I've mentioned this before. Our model was clients. Relationships. How many active clients do we have? We almost considered them subscribers. Most of our competitors ran their business on transactions. How many shoots did we do today? Which is, in our mind, was death by 1,000 cuts because churn in the real estate business is like 25-30% a year. There's no loyalty. If you're trying to be the low-cost provider, there's always somebody who can do it cheaper. So you're spending a fortune to acquire new clients and they never order again. Where we spent our money acquiring clients who we knew were going to order 5, 10, 20 times a year and stay with us for 5 or 6 years. So we would bring that model. So, you'd have this business in Dallas or whatever doing $2 million in revenue. And I painted an overly rosy picture. Usually they were losing money. They were blowing through.
And the multiple on zero is zero.
Well, it gets to the negotiation.
You're a break even company and you want a 10 times multiple. Okay, that's zero. 10 times zero is zero. But
yeah, when you put an entrepreneur or a business owner on the hot seat and say, what's the real end game here? How do you ever get out of this? Because a lot of times they feel like that. Like, I'm I'm on a hamster wheel. I can't get out. The stress is building. I've committed personal, money to this.
Encumbrance. You're encumbered because you've got, maybe you're pledging assets.
Yeah, I've pledged assets. Now I've got kids that I got to take care of. These are all things I didn't think of when I got into it. Now somebody comes in and says, guess what? Congratulations on building what you built. It's not worth as much as you'd like, but it is worth something. And oh, by the way, while the cash up front is enough to help you, get out and buy a new car, buy a boat or whatever, the rest of it's going to be an earn out, over 2 or 3 years to see if you've really built a good business here.
And that's what you're saying.
For your business, we'll give you this. Tito's.
Right, so to your point, if we're talking about multiples, but it is at zero, then they're just looking for either to get out. So their business is still worth something, but they're not going to get any return off of zero.
Yeah, I mean, that's a discussion that comes up in our space, other space, and all that, is that as you're growing and you're pouring money back into the business. Let's say you have 6 hot dog stands and now you're going to open a 7th or an 8th. Okay. If you keep pouring all your profits back into the business and then somebody expects that they're going to buy you on a multiple of your cash flow, you've just poured your profits back into the business to keep growing. And so what you need to demonstrate for the acquiring company is that, no, wait a minute. Before we bought these we built these last 2 centers or hot dog stands or clothing stores or restaurants, whatever, before we did that, we were profitable. This is what we were doing. And so I actually want credit for those 2 stores I opened that haven't yet fully matured yet, because they're going to be profitable for you. So don't give me the multiple on today's value. Give me a multiple on what I was doing and the path I'm showing you forward. And a lot of times, to Brian's point, that's a negotiation. Yeah. That's where someone that's buying or acquiring somebody will say, I don't buy that. I mean, I don't believe that story, so I'll give you less. And of course, you're going, do you know what I just went through to get to this, to build that out? I want credit for where it's going. And that's the rub when a company goes to acquire another, and that's the negotiation that occurs, right? But would you say, Brian, anything outside integration number one problem in the acquisition world? And
it's variety. Integration is a really broad term, because Matt brought up there's culture. If there's a culture clash, you need some of their employees, you may lose them. That's a risk. And the employees have relationships with the clients, salespeople, processes. Do they do things the same way? Or are we going to have to change the processes? And then systems, technology. It always comes down to technology. And in our industry, everybody had homegrown systems. So it wasn't like, oh, you're using Salesforce, we're using Salesforce, they're using Salesforce, we can just combine it. It was, you built your system on .NET, we built our system on Python, you built your system on something else. So we were fortunate in that, we had money early on to build a system that was very open. We always said, for our clients and for the future growth of the company, we want a very open platform. So it benefited us when we went to acquire people. It was a lot easier to fold them into our system. But we would look at their systems and they were totally inflexible. Like, they built it just for themselves and just the way they do business, and that's it. Like, if you wanted to change anything, you had to rewrite the code from scratch. So that helped us a lot. And it's a skill that I've really come to appreciate more so recently, is integrating companies. You need a team, an integration team, to work with the new company. You can't just say, oh, we acquired them, now let's just put them on our systems. Yep. Somebody has to own it. As a project manager, there has to be a plan. You have to identify the critical path items. You have to budget for it. Like, we could buy, one of the other calculations we used to do, we talked about this in marketing and sales, is you got to know your cost of acquisition of a client. So if it costs you $500 to bring on a new client, and we're going to go into Denver and this company's got 1,000 clients, it's like, okay, we wanted them on our own, it would cost us $500,000. So, your initial reaction is, well, we could pay them $400, $450 and we'd make out on this. But you got to factor in okay, we got to get their clients onto our system. There's going to be some churn.
There's going to be churn.
So
There's going to be fallout from the customers that you do inherit. They're not all staying.
Yeah.
They're going to get aggravated because there's a change. There's a disruption.
So those are the things you got to get really good at. And you got to do this stuff quickly. And I know employees always complain about this. It's like, oh, we got acquired and they said it was going to take 2 years to integrate and we weren't going to make much change, but that's death for a company. You got to change like that.
So you do. So you're a subscriber to, if you've acquired, XYZ company, do you believe that the branding and everything is changing overnight, like signage and
branding's
brand
the most difficult. Everything else has got to change
because if it's embedded in that community and that's what they know, whether or not they're belonging to the new, bigger, better VHT Studios, XYZ is known in that market, and that's their name and that's their brand. So you still have to consider that, right?
Yeah, I would change everything else first. And usually, again, for us, it wound up better for the client. Hey, you're going to get a better ordering experience. You're going to get a better service. You're going to get better billing, better delivery. So they would see the change. And we would add, powered by VHT or, XYZ company, a VHT subsidiary. And then over time, it would just become VHT. But it will kill you if you try to run 2 or 3 different operations. Your employees and your operations people will go nuts. It's like, wait a minute, we can't have one order process for Seattle and then a different order process for Detroit and then a third order process for Miami. These have to be simplified, streamlined, standardized for this to
rip
work.
off the Band-Aid, they'll adjust. Don't leave them with the anxiety of what's coming and when's it going to
build it into your financials. Yeah. We're going to lose this many customers because we have to do this quickly. But hopefully what you do it just as quickly is bring your sales and marketing expertise to that market and really elevate that provider. Like another thing that happened with us is most of the providers were really good at working with individual agents and individual offices, but they didn't have the infrastructure to work with a Coldwell Banker or a Berkshire Hathaway or a national chain. They couldn't do the integrations with their billing systems and their websites and their print partners. We had all of that. So when we would come into, Des Moines or something like that, we could say, hey, we've already got Berkshire Hathaway on all our systems. Now all of a sudden that local guy that has 5 photographers and 2 customer service people, he's servicing 2,000 agents that he would have never been able to do on his own prior to VHT coming in. So,
and that wasn't too small for you. One agent, cup 5, you would that would be attractive to you, those smaller operations.
Photography operation or real estate? Yeah, generally, no. I mean, the acquisitions we did were bigger.
Bigger, yeah. Okay, so I thought.
People would come to us and say, hey, I want to sell my company. And if it made sense, if it was in a place that we needed photographers or something, we would do it. But the ones we did were more, either strategic, financial, strategic to get into a market or to provide service to a national account, or they were financial because it just made sense and it was quickly accretive. And so the last, 7 years of running VHT, that's all I was doing was acquisitions.
How many companies did you guys ultimately acquire?
About 10. All total.
So that's interesting. So it was so funny. I was prepared to do a point counterpoint on this.
Yeah.
I thought this was going to be like, all right, let me tell you why you better be talking de novo organic growth versus inorganic. But I tell you, I mean, the amount of things that you brought up as benefits and ads and dispelled rumors that or dispelled misconceptions I had about you better be sitting on a pile of capital in order to be able to do that. You're saying, yeah, it'd be nice to have it, but it's not necessary. And, that could lead me to believe or potentially adapt a different approach, or at least a concurrent approach as we're going acquisition and de novo do it at the same time.
That's great. And that's actually one of the other risks I was going to point out. You said, hey, well, it's all bright and
because
cheery,
if that flops and you've got a lot of investment into something that heavy churn of clients, employees don't integrate well, they take off, or key inherent leadership roles that you were counting on inheriting leave, I would think that you're inviting disaster in an accelerated manner via acquisition.
Not just the acquired company, your core business starts to suffer. because employees are distracted and they're dealing with problems. Oh, the stupid people from, Detroit are messing up everything. And they're, I don't like working with so-and-so and their thing is different. And why don't we just change this? And so, or culture, there's a lot of risk if it's not managed correctly. Not just that you'll screw up the acquisition, but you'll screw up your core business, your cash cow.
Well, I think this topic in of itself, it started off a question.
Yeah, I was just
started off with India, but
It started with India.
I wasn't clear. I was just looking for a sentence from each of you. I have 20 more questions. No.
I mean, we are just under an hour talking about this topic, and so I think there's a lot more to discuss on kind of de novo organic growth, the advantages of that. But I think you touched on a lot of things that we should probably kind of put a pin in it here and say, look, from an inorganic acquisition standpoint, for those that you're out there wanting to grow your business, I think Brian provided a lot of different key, when you're thinking about considerations of why you do it, the positive route of that. And by the way, if it didn't work out after acquisition 1 or 2, I don't think you would have done 10.
you wouldn't keep going, right?
Right. And
this is relevant. I just want to ask you quickly, how did you value a company that you were going to shut down? Because you knew
how much we could raise our prices by to the client. So, if we can raise our rates by 300,000 and buy these guys for 200,000, it's a win, But that's the easy math. Again, you've got to remember all the other expenses. There's expenses in shutting them down. There's expenses in transition. That's where you tend to get killed, is if you only do the simple math and you forget about the churn and the other things.
Have you ever been through it as an employee?
An acquisition? Oh, yeah.
We've been with the company, been acquired, and
yes,
had a deal
twice. We've been acquired on the tower side.
And how was that for you?
It's like you said, it's the integration's always a challenge. It's different because you're going into new processes, new programs, new system,
and you were never replaced on either of those.
Yeah, and they worked out in both cases. So no, Brian opened my eyes to a few things in what he explained during that session. So I think we should, hang it up there. Great. Talk about maybe de novo and organic growth on a future podcast, because I definitely think there's a lot of advantages to that. But hopefully the viewing audience took a lot from that, especially our good friends in India. By the way, to end on this, I did tell you guys, what was the game that was invented in India? Do you guys recall?
Cricket?
No, it was chess.
We talked about chess.
Yes.
I get it.
And actually the current chess champion is now from India, as he defeated Magnus Carlsen in the World Championship just recently. Magnus Carlsen's very well-known chess player, just lost to this individual.
Was that the viral event where I saw him? He banged his hand on the table.
That was it. I don't know if that was a World Championship, but it was a prominent chess event. It could have been World Championship, it was to a 19-year-old gentleman from India, and that's where the game was invented. But right, good stuff, good advice and counsel.
Now we're going to start acquiring other podcasts.
All right, hey guys, take it easy. Until next time, see ya.